So much for that. Also joining us to talk about the first quarter results are Mamta Verma, Chief Investment Officer at DC India Capital. Mamta, thanks so much for joining us. I think let me take on from what Corey left off over there, that companies are preferring to keep their market share rather than their margin. Does it also indicate that their elbow room in terms of pricing is that much lesser right now, and that's going to be pretty much something to watch out for?
Okay. It would be incorrect for me to kind of generalize this and say that across sectors, that's been the trend, that companies have been focusing on maintaining market share and that there's limited elbow on pricing. I think we started this earnings season on the backdrop of high input cost inflation, which was also expected to put pressure on the core operating margins of the companies. But if one were to kind of look at results across sectors, especially, in the consumer sector, be it consumer staples, be it consumer non-staples, some of the consumer discretionary names, one has seen that companies have both registered strong growth in revenues, as well as they have been able to grow the gross profit, which is essentially net sales less the raw material costs on an absolute basis. And so it is very heartening to see. In fact, most of the market leaders have been able to, I would say, pass on the pressures of input costs. And sometimes, this may come with 1 quarter lag. So one may see that, on an optical basis, the margins may look lower, but in absolute terms, the gross profits have actually grown. So, in fact, at our end, we've done very detailed analysis on companies across sectors and with market capitalization right upwards of $50 million. And one very important takeaway that we've seen is that companies which are market leaders have been able to pass on the input cost pressures. They have been able to grow both revenues and gross profits, maintain EBITDA margins, whereas companies which have been on the margin, fringe players, they have kind of taken more of the beating both on market shares and on operating profitability.
Two of the weakest links as far as results were concerned were auto and infra related. Infrastructure is down about 47% on an average. That's the profit after tax. But what is interesting from my point of view is that we've seen a pickup in auto stocks in the last 1 month, and even there seems to be a differentiation because a Hero Motocorp, a Bajaj Auto, a Maruti are in the positive, while a Tata Motors is down about 22%. Even on over a month period, which will be post these results on the ground. What sense are you getting of this?
See, I think autos, which is over 8% of the Sensex, one very clear trend has been that if we look at the two-wheeler pack, Hero, Honda and Bajaj Autos, I would say that the numbers have come in line or just a marginal disappointment, as in the case of